Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Joining us now is Dana Peterson of the Conference Board, alongside Matt Diczok of Merrill and Bank of America Private Bank. Dana, can I come to you first, please, and just get your response to jobless claims? The scare of a few weeks ago, is it over?
Well, we don't really know, but the thing is jobless claims are still extremely low. And as Lisa said, many companies are not letting their people go. They're holding on to their workers, they're hoarding them. And so we're probably not going to see much uptick in the unemployment rate going forward. Companies need them, and also they're facing lots of people retiring. So I don't really see the labor market weakening significantly over the next year.
Matt, to bring you into the conversation, do you share those thoughts? Do you have that constructive view a year out?
We do share those thoughts on the employment market. Corporate health looks very good right now. At the end of the day, that's what's going to drive the employment market. How are companies feeling? How are they doing? So we do feel very good about that. We're not too concerned about it. But the idea that rate hikes don't work, the idea that it won't slow the economy somewhat, we'd be a little skeptical on those kind of arguments that we're hearing.
Well, okay. Just taking a step back, you were the one, and I think I misattributed this earlier, saying that the Fed pretends to be inflation sensitive but is actually employment sensitive. You say rate hikes work. It might just take a lot longer. Does that preclude the idea of a rate cut if they're employment sensitive and inflation is still too high?
So we do believe our baseline forecast is we will get one rate cut this year, probably in December. But to your point, it will take time to see these rate hikes work their way through the economy. General monetary policy lags like a year to 2 years. 10-year just peaked in October, November of last year. It's about 6 months ago. Fed funds rate just peaked about 9 months ago. So we're not even in that 12 to 24 month window. Come back to us in early, mid, late 2025 to see how these rate hikes work. So we do think we're starting to see some of that now. Uptick in credit card delinquencies, uptick in auto delinquencies, some slowdown in consumer spending, retailers that are reporting earnings, seeing a little shift in mix, and lower income guys pulling back a little bit. So we are starting to see those effects. We believe we give it time, we'll get there.
So Dana, can you weigh in on just sort of the odd discrepancy right now between what Matt was talking about, the slowdown, between the data that shows that jobless claims are not picking up and the fact that people feel really bad? I mean, do you have a sense of whether it will take actually getting laid off for them to stop spending entirely, for that to actually crack the market in a more material way? Or do you think that this steady softening will eventually just bring us down to that soft landing nirvana?
Well, consumers have mixed feelings. For the most part, they're happy that they're working right now, but they are still very upset about inflation. And certainly when they look out 6 months from now, they have concerns about their incomes, employment prospects, and also business prospects. And so that's why we've seen some weakening in our consumer confidence measure. But when it comes to spending, we are seeing consumers pull back. Certainly they're not buying homes. And once the Fed raised interest rates and mortgage rates shot up, the housing market responded almost immediately. We also saw that businesses stopped investing because the cost of capital was rising. And we see that consumers are pulling back on goods, and our consumer confidence survey suggests that they will continue to pull back on those big ticket items. The big question now is services. Can they continue to spend on services? And the thing is that right now consumers have run out of that excess savings. So a lot of the trips and things that they're going on, the services they're consuming, they're putting it on credit cards. And we know that interest rates are very high for credit cards, and the debt service is rising. So I think that this is all part of the plan, and that we will continue to see consumer spending slow, and that we'll probably have a bit of a soft patch this year. But as long as consumers are continuing to work, I think the Fed can continue to focus on inflation.
Dana, how well aligned is consumer confidence with CEO business confidence at the moment?
Well, CEOs are, I would say, cautiously optimistic. For about a year and a half, they were very negative. And then in the last 2 quarters, it ticked up above our 50 threshold in terms of optimism. But still, businesses are saying, look, we're not having trouble finding qualified workers. We're not laying people off. We're just holding on to people. But we're not looking to invest much. And the thing is that we are still facing high costs from labor because they intend to continue to raise wages to hold on to their people. But still, they're very concerned about a number of risks, especially the implications of the elections coming up and also a number of geopolitical issues. So I'd say CEOs are not as gloomy as they were last year, but they're still very cautious.
Matt, this is what we're trying to figure out, how the dominoes fall from here. We can identify this week that some of these retailers have lost pricing power. That's clear. The CEOs are talking about it. What we're trying to understand is what happens next. How do they protect margins? Do they pull back on costs? What can they do? Do they lay people off? To Dana's point, do they hoard, given the experience coming out of the pandemic? What do you think the ultimate outcome will be?
We do think labor hoarding is probably going to continue. And again, when we think about this in a larger context, this is not pessimistic news. This is good news. This is what we want to see. We need to slow the economy somewhat to continue to bring inflation down. But the big picture, inflation was 9%. It's now down to 3.5%. Core PCE is already below 3%. We don't have to worry that much about getting down to that exact on the screws 2% PCE number. We're in a much better place right now. If you look historically at equity market returns, it doesn't matter whether you're 0 to 2% inflation or 2 to 4%. You do just as well in nominal, just as well in real. This is a good news. What the Fed is doing will eventually work. They can keep rates about this level, maybe trim a little bit end of the year. And if they do that, we could have that mid-90s setup where everyone thought a recession was happening. It didn't happen. Credit spreads stayed tight for a while. Equity is absolutely ripped for the rest of that decade. So the slowdown we're seeing is optimistic, warranted, what we want to see and what the Fed's trying to encourage.
So it sounds like you agree with Dana that this is just a soft patch, not going to be softer for longer. But to Jon's point, if these companies are having to cut costs, you don't think at any point that will mean letting off employees?
Oh, no, I absolutely do believe at some point, if it continues on this trajectory, that's exactly what you see. But that is what you expect to see. So it's always a question of when that starts to happen, what does the Fed do? And as Ashok had said earlier, I believe it was, and we completely agree, pretends to be super inflation sensitive. Now that 80 to 90% of the inflation fight is done, they're not. They're employment sensitive. So when they start to see that more, which we're not yet, but we will, then they'll adjust tack. Then hopefully they cut in December. Then they'll cut next year, fine tune, keep the economic expansion going.
Dana, let's build on that. How does that influence your Fed call for this year?
Well, we have the Fed cutting twice this year, probably at November, December meetings. But I have to disagree a little bit. I think the Fed is still very inflation sensitive, and they're probably a little less labor market sensitive. Why? Because, they'll be okay if the unemployment rate rises a little bit. We have it topping out at 4.2%. That's extremely low. Most people who want to work will work. But the problem is that everyone experiences inflation, and they do want to get key inflation gauges back sustainably to the 2% target. Sustainability is important. They don't want to just touch it and then move off of it. And the thing is that they have to do that because of credibility purposes. They say their target is 2%. They want to get it there.
Matt, do you have a response?
So as we think about the inflation numbers, and again, they're going to officially keep their target 2%. We believe that. But, and you don't have to be a math major for this one, if your inflation go to 9% and never let it go below 2, you're probably not going to average 2%. So they've already de facto kind of faded in that inflation target a little bit. Again, we don't find that to be a tremendous problem. 9%, 7%, 8% inflation, problem. 2 to 3.5% inflation, not a problem for nominal GDP, not a problem. And meanwhile, fixed income valuations are so much better now. The 10-year was around 3% when CPI was running at 9%. Now we've got the 10-year about 4.5% and CPI PC below it. These are good valuations for fixed income investors.
We'll get to the bond market in just a moment. You say not a problem. Why did Governor Waller give last month's read a C+ if it's not a problem?
To be fair, we're trying to be optimistic here. I'm the bond guy. I'm trying to be positive. There are problems within the inflation data, particularly as we've all talked about on the services side. And right now we're getting goods deflation or almost no inflation, about 0%. But you can't have an average inflation number of 0% goods and 4% services. And we are seeing an uptick in services. So there are definitely areas that they need to focus on and watch. And the fight's not done. But again, they're much closer to done than they have been, and some fine-tuning hopefully gets them there.
Dana, I want to pick up on something that you said. You think that this Fed is particularly inflation sensitive and less employment sensitive at a time where potentially, we were speaking with Adam Posen of the Peterson Institute yesterday. He was talking about how a policy shift come December or January of next year could single-handedly mean an increase in tariffs or potentially a change in the immigration policy. And frankly, the extra immigration, a lot of people are arguing, has put a downward pressure on inflation that otherwise would be in the system. Do you think that given potential inflationary policies, that would actually put the Fed in a really awkward position with a labor market seeing the weakness that you're expecting while also seeing inflation remain sticky or even inflect upward?
We're already seeing inflationary pressures from policy. Certainly industrial policies and the trade wars that we experienced back in 2018, 2019 that are still going on, those are all placing upward pressure on inflation. And so the Fed this is the new norm. The Fed is going to have to operate in the world that it's in. And as it sees policies or consumer behavior or external events like climate events that are pushing up insurance costs, whatever it is, the Fed is going to have to deal with that within the bounds of its mandates, right? And so I think that, for this year, the Fed probably will see that slowing in inflation that it wants to see. It'll feel comfortable cutting rates 1, maybe 2 times this year. But next year's another story. And they're probably going to have to take a more gradual approach to cutting interest rates next year. And I think where rates will land will be higher than what we saw during the period between the Great Financial Crisis and the pandemic, both in nominal and real terms. I think that's the new reality. Inflation pressures, upward inflation pressures, are the new reality that the Fed is going to have to resist day in and day out.
Which, Matt, really points to this reason why maybe people are so optimistic about equities right now, because that environment is supportive of equity valuations if inflation's actually allowing them to increase profitability and some of their revenues. As an investor, as chief investment officer, do you say it is a safer bet to go with equities at this point than certainly duration, given that type of backdrop?
We actually don't. We actually have a slightly different view there. We do like equity risk here, to be fair. We are slightly overweight equities. Again, 2, 3, 4, even 5% inflation. Again, if you can grow your sales at that level without selling more goods or services, your earnings will do fine. Great for equities. We do want to take a little more macro risk in the portfolio, so we are slightly overweight equities. At the same time, if we look at the valuation picture on fixed income, you can easily build a diversified investment-grade portfolio today of over 5%. You haven't seen that in 20 years. More importantly, in real rate terms, 2 to 2.5% real. If we were talking January 2021, it was negative 2%, right? For the privilege of giving your government $100, you could get $80 of purchasing power back in 10 years. Thanks for that. Now you can give them $100 and you get $120 back in 10 years. So again, that actually gets a bond guy excited. I know maybe 5% yields, if you hold it for a whole year, you can get half the return of a particular tech stock pre-market. But for a bond folk, that's actually interesting. And we have to build portfolios for, right? Joking around a little bit, but we have to provide portfolios for is what happens we don't expect. And we do expect that treasuries, investor-grade corporates, agency mortgage backs, they will provide diversification. Maybe a little bit in terms of price if rates come down, but more importantly, by steady, reliable, predictable income year in and year out, that's how they will diversify portfolios. So we're actually slightly long duration at the moment.
Doesn't take much to make you happy after the previous decade with rates so low and negative. Matt, it's good to see you.
Good to see you, John.
Been too long. Thank you, sir. Matt Diczok there of Merrill and Bank of America Private Bank alongside Dana Peterson of the Conference Board. Nvidia soaring after delivering yet another beat and raise. Sarah Hunt of Alpine Saxon Woods writing this. Margins look quite strong, although there will be a point at which the undersupplied market becomes less so. In other industries, companies do not get as much credit when they are over-earning. But the bloom remains on the rose for Nvidia here. Sarah joins us now for more. Sarah, let's just start with those stellar numbers once again. The bar gets higher, they keep beating it. How impressive was that yesterday afternoon?
I think it was pretty impressive, and I think that the concern was that there might be some slowdown in the change of, it's been the rapid change higher has been so fast that the question is if that slows down, do people get worried? People are not worried, and I think the fact that they're able to absorb those when they have something new coming, also tells you that people want to get into this game, and it doesn't matter if they have to wait for something. They'll take what they can get right now because they don't want to get left behind in their own development. So I think that it was a very strong report. It needed to be a strong report. Like all of Q1, these stocks needed to perform. They did, and that is driving right now, what you can see is another series of potential all-time highs today.
You can see it on the screen, up 7%, Nvidia, Broadcom up 2%. ADMD up by 3% in the pre-market as well. Sarah, when you go through these names, there's an AI theme. What is and what isn't driven by this theme in this equity market right now, given utilities are up by 7 to 8% so far this month?
I think it's a lot of the stock market is hanging on not just the idea of AI in and of itself, but the productivity gains that it's going to bring and the fact that that can help with its economic growth. And I think that's been the biggest question is what happens coming out of this pandemic and what is going to fuel the next leg of growth in the economy. And this is at least giving the market a story to tell itself. Whether or not that's going to happen in the time frame that people are looking for, someone was talking about how long it takes to permit electricity changes. It's enormous. There's a long time frame that's going to take, but you've got an infrastructure build that's going to go on here. And I think right now, as we get more use cases, that seems like something that we can continue to think about. If it turns out that this doesn't work as well or it's not giving that productivity, that'll be a different story. But we're not even close to that concern yet.
What I find fascinating, Sarah, and John was alluding to this, the idea that we talk about the Fed rate hiking cycle that left rates the highest levels in decades, and why is this economy so insensitive to that? Well, you overlay a super cycle that is completely secular, that is independent of the macro cycle with respect to Nvidia and all of the investments from big tech. How much can that keep going regardless of what happens in the macroeconomic backdrop, regardless of whether there is a downturn in some of the areas where we're already seeing softening?
Well, that's an excellent point, and that's exactly sort of when people start talking about is the economy rate sensitive the way it used to be. In this particular sector, it isn't. In fact, higher rates for companies that are both cash generative and have a lot of cash sitting on their balance sheets is helpful to them because it's giving them some return on their cash, where for the last decade and a half, they were getting nothing. But it's these giant cash-generating juggernauts that are really fueling the spending boom, and that's not going to be affected by higher rates. So I think that there is, had this not come about, this AI cycle, I think the market would be struggling because the question would be, what's going to happen to the economy next? This is giving people a reason to say there's a lot of ways that we can see efficiencies here. Unfortunately, I think a lot of those efficiencies are going to end up being with less people working, but that's a question as we move forward. It's not a question right at this minute. Right now, we're building the infrastructure. And if I think about the build out for the internet boom and how dark fiber and all these things that were ancillary to the internet growing, you had a lot of companies that were generating no cash. You had a lot of customers that needed to be financed. Right now, you've got customers that don't need any financing. They've got plenty of cash. They're willing to spend it. And I think that that's in and of itself a cycle that is not necessarily rate sensitive.
We were talking earlier this morning with Adwaita Bahuguna about whether the 60-40 is kind of dead. And I would take that a step further and ask a question about whether some of these big tech stocks are the safety plays at a time where there's more uncertainty on the fiscal side, there's more uncertainty on some of the monetary policy than there is in just the ability for these companies right now to make bank even with their cash piles.
Well, I think that becomes a question of valuation. And there's been a lot of discussions about valuation, how valuation in and of itself doesn't stop cycles. But there is a point at which that there is a higher risk to the reward. And I think in some of these names, you're starting to get there just in terms of another kind of economic slowdown or some sort of hiccup in terms of some of these bottlenecks that we're talking about solving on the utility side and elsewhere. If you start to see companies having trouble getting data centers and getting room in data centers and getting them built, which I think that there's some discussion on the edges of right now, you could see some timing delays, and that could put into question the high valuations right now. But in terms of the longevity of this cycle right now, just from what you're hearing from Nvidia and the discussions about what people need, and the other companies that are trying to get into this, I think you've got a runway on the demand side that's difficult to say there's going to be a problem unless there are bottlenecks.
Sarah, when you talk about the potential for AI disrupting the labor market, John Authors recently wrote about this and talked about how Nvidia's place isn't exactly so healthy. This would mean taking capital expenditure from other companies. This would potentially mean taking jobs away from the American workforce. When does that story actually start to bite?
Well, I think all of technology has been a continuum of finding ways in which to make productivity better, which also very often requires letting people go or having less people. But I think that, Mandeep Singh had a great discussion yesterday about how annoying chatbots and all the other things that we've been looking at as AI have been to users, and how that experience is going to get better. So some of that's already happened. It's just you're going to start to see a better situation in places where you've already replaced people with technology. The question going forward for AI really is how does that broaden out? And to the extent that it does, how damaging is that to the labor economy? And I think that that's a question we don't really have an answer to yet.
Is there a company now that you think could potentially get on the AI space that is not, and that we have yet to see within the tech world?
I think everybody is trying to get into the AI world, and the question really is how can they use it? And this goes back to the use cases and whether or not they generate money. I mean, you've seen on the web hosting side, you've seen in Microsoft and ChatGPT that there's money to be generated here. The question is, are companies going to find it useful, and are they going to continue to invest in it? And right now, the answer is yes. Down the road, where does that end? I think every single company, we've already been using AI for the last decade or so in different ways. This is just the large language models make it an iteration better, and makes everybody try to get into it in places that they weren't because they didn't like the use cases that were there before. So I think that there is not anyone who isn't going to be working into this space. The question will really be who ends up using it better. And I don't know the answer to that. And it may very well be that some of the old economy stocks start to get much better data and use it better. We don't know yet, but I think that's the promise, and that's what people are expecting.
Sarah, just quickly, it's something Lisa mentioned a few times this week. We've talked about it before, how utilities are going to perform at a down market. And we got an experience of that yesterday. They actually helped lead the losses on the S&P 500. Given the way they've been bid up on this theme, are they defensive still in the equity market?
I think it's hard to make the case that they're defensive. And as I said, for the utilities especially, you've got a lot of issues that go into permitting. You've got a lot of issues that go into spending. There's a lot of discussion about how we're going to have to build out a better grid, and we are. That's not a question. But the timing is the question, and the regulatory backdrop is going to be the question, and how fast you can get things done, because there are awful lot of projects that people would like to do that get hindered with all sorts of NIMBY issues and everything else. So I think that there's a timing issue for that, and there's an extent to which those get bid up that are also on the yield side. You put those two stories together and it makes them a bit vulnerable.
Got it. Good to catch up as always. Sarah Hunt there of Alpine Saxon Woods, following those strong numbers once again from that name, Nvidia. Holger Schmieding of Berenberg writing this: the Fed may prefer to wait until after the election is out of the way. If either side wins a clear victory, US fiscal policy may become more expansionary once again, with significant new tax cuts from Republicans or further spending increases from Democrats. Holger joins us around the table. Holger, good morning to you.
Good morning.
2025, sir. Talk to me about the prospect of rate hikes next year. Adam Posen making a case yesterday.
I don't quite believe it, because we rarely get in the US an election result which is so clear-cut that one of the two sides could, in terms of fiscal policy, where Congress is in control, really do something dramatic. We had huge fiscal initiatives in the US right after the pandemic, when everybody was kind of panicking. We knew to do something big. But now, with that unusual situation over, we will likely be in Congress, be in regardless sort of the election result, the precise details, into the kind of usual gridlock where not much happens. And that means the fiscal impulse, which is currently propping up the US economy, will weaken over time, and that argues for rate cuts next year rather than rate hikes.
What kind of budget deficits are you expecting? We're running deficits of something like 6 to 7%, with unemployment south of 4%. What are you expecting? What's your base case?
That's in a way a separate question. Even with the fiscal impulse sort of petering out, the US will likely have fiscal deficits in the range of 6 to 7% for quite a while. But this is sort of no longer new. Yeah, in a way, that's not a new fiscal impulse. That's just continuing the strong fiscal stance which we've had. That's not new money giving you new growth. Yeah, it's just supporting the economy at the level it is. So basically the case is we need to rebalance the US policy mix over time in, and that means monetary policy less restrictive than it's now. We don't need to do it now, but we probably will have to do it in the coming years. Our call remains, as it has been for quite a while, first cut in December.
It sounds like you didn't make much of the minutes, that it didn't change your view, and that you think that maybe people are overreacting when you say this is a hawkish tilt, it's changing everything.
Well, it is a hawkish tilt, yes, but first of all, we were not expecting a rate cut before December either, so for us that's just confirmation, okay, they're not close to cutting. They need a lot more evidence, and these are of course the minutes which came before the latest economic data, which all sort of consistently show a bit of weakening of economic momentum, plus that inflation for once did not surprise to the upside, but to the downside. So in a way, this is kind of past news, the minutes.
Everyone was talking about U.S. exceptionalism. I'm wondering how long it's going to be until we're talking about European sweet spot or European Goldilocks, considering the fact that we got better than expected activity data, in particular out of Germany, at a time where the ECB is basically committed, all but committed, to a June rate cut. How positive is that for the economy in the European region?
Well, Goldilocks is possibly a big word, but indeed what's happening in Europe is the big Putin shock is over. That is the surge in energy and food prices, which drove the economy into stagnation and drove inflation up. We are now returning with much lower, still somewhat elevated, but much lower energy prices. We are now returning to normal, and normal does mean growth. Growth of close to 1.5% by the end of this year, and normal means inflation settling a bit above 2%, and as a result, the ECB no longer needs to think about inflation getting too sticky, too permanent. They can afford to cut rates somewhat.
When you look at the ECB, though, it's pretty much certain they're going to cut in June.
Yes.
What happens after?
The ECB, in my view, will be in the slow lane. That is, we do not look for back-to-back cuts. We expect sort of quarterly moves, in the next one September, then December, early next year, because inflation will now probably hover around the current level. The economy will be picking up. It will probably be only late this year when falling household prices for gas and electricity will probably bring headline inflation to or slightly below the target rate of 2%. And that's when probably the ECB will then do a lot more cutting. At the moment, they have pre-announced the June cut, but they'll be in the slow lane for a while thereafter.
Holger, I'd like to circle back to something you said in the beginning about how for this huge fiscal impulse, you need a sweep of Congress, which Adam Posen also agreed with. But there's one area that could be inflationary that you don't need a sweep in Congress, and this is tariffs, and that would affect central banks around the world. How are you thinking about potentially a Trump administration putting a 10% tariff ring around the United States and 60% tariffs on Chinese imports?
Well, tariffs are bad. Sometimes there are good reasons for tariffs. Yeah, there can be reasons, sort of, if really there is too much of subsidies going on, yeah, but basically tariffs are bad. Tariffs make all of us a little poorer. But the impact, however, on U.S. inflation, this is a huge domestic economy where imports play only a modest role. The impact on U.S. inflation may be in the 0.1, 0.2 percentage point range. I don't think that would really make the crucial difference. It would be a bit bigger in smaller economies if they protect themselves, in inverted commas, protect with huge tariffs. Their impact on their prices would be bigger. So this is a huge concern, the tariffs, but less so for the inflation outlook.
But when you say tariffs are bad if China is dumping supplies on European U.S. markets and absolutely obliterating their own industries?
Well, the first economist's response to that is if they give us a little gift, yeah? If we can get the electric vehicles cheaper, the solar panels cheaper, thank you for doing that. We don't have to spend the money on it. You in China spend the money on it with subsidies. The snag is, of course, if that causes too much of a disruption, yeah? Then, of course, you might want to slow down the process, or if there are security concerns involved. And probably less so for solar panels, but with cars, electric vehicles, who is getting what data, yeah? Do I want China to know where 25% of the European cars are currently parked? Probably not. So there are serious security concerns which need to be addressed with China. It doesn't have to be tariffs. It has to be, for instance, like forcing them to make absolutely clear who gets what data, or that the key data-relevant components actually have to be produced locally in the US or in Europe. That's, in a way, I think, a better strategy than to have these blanket tariffs.
Holger, you've got client meetings here in the US. How much daylight is there between the US perspective and the European one on this issue?
Well, I think there is among clients, among economists, not all that much disagreement. There are, of course, more political considerations. Well, you have the election campaign over here, which play a role. There are, to some extent, political considerations in Europe. We also have this not quite as important European parliamentary election, but among, I would say, the majority of investors and economists, there is a rough consensus. Basically, tariffs are bad, but there are exceptions when you really sometimes have to strike back. And especially if you want the other side to offer concessions, you have to show your weapons. But after showing your weapons, you should sit down at the table and talk rather than just wield the weapons.
Well, you know the German economy better than most. What do you think the German automakers want right now? The walls to go up in Europe and access to China?
They'd be the most unhappy with any tit-for-tat trade war, of course,
no doubt.
With China. No doubt. Having said that, this is not the key concern, I would say, for Europe, and it's also not that much the key concern for the German economy. We have to distinguish between two things. The one is the profits that companies make who are listed on the German stock exchange. The other is what's actually the impact on the German economy, and that probably would be much less, the impact on the German economy. We have a shortage of skilled labor, for instance, yeah? That would be much less than the potential impact on the profits of companies who do a lot of business in China and may do less business in China in the future, if, what hopefully won't be the case, if this escalates.
Interesting perspective. Holger, thank you. It's good to see you, as always. Holger Schmieding there of Berenberg on the latest out of Europe, the United States, and Lisa, the trajectory for policy too.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.